Market momentum gets attention, but infrastructure stability determines survival. In digital asset markets, institutional capital isn't driven by how fast an asset rises. It's driven by whether the system behind that asset can perform under stress. This is where infrastructure stability becomes central to capital preservation. Momentum can create short-term performance, but it doesn't guarantee execution. If a network slows down, validators fail, or transactions don't settle during volatility, risk increases in ways price alone cannot reveal. For institutions, this is the foundation of risk discipline, prioritizing systems where operational continuity is measurable, not assumed. Network reliability is a precondition for capital allocation. In traditional finance, uptime and settlement certainty are expected. In digital markets, they are still evolving. Congestion, outages, and validator instability have historically disrupted execution. During peak demand, delays and unpredictable fees expose structural weaknesses. For institutional allocators, these are not minor issues. They are barriers. Without reliable transaction processing, capital cannot be deployed or repositioned efficiently. That's why consistency over time matters more than isolated improvements. Validator performance is another critical layer. Behind every blockchain is a validator ecosystem, maintaining consensus. If validators are centralized, inconsistent, or unreliable, the integrity of the network is compromised. These risks may not appear in price movements, but they directly affect transaction finality and security. Institutional frameworks now assess validator distribution, uptime, and incentives before allocating capital. Because reliable consensus is not just a technical feature, it's a capital protection mechanism. Transparency also plays a defining role. Early market cycles were marked by opacity around reserves and operations. Today, on-chain analytics, proof of reserves, and real-time reporting are improving visibility. Institutional capital depends on this clarity. Without it, participation is limited. Recent market cycles have reinforced a clear lesson. Assets driven by rapid momentum often struggle under pressure. Exchange disruptions, liquidity fragmentation, and smart contract vulnerabilities highlight the gap between adoption and infrastructure readiness. Momentum may signal interest, but infrastructure determines viability. DeFi is also evolving. What began as an experimental space is becoming more structured, with audited protocols and compliance-aware systems enabling institutional access. Still, infrastructure stability will define how quickly capital enters. At Kenson Investments, infrastructure is treated as a primary factor in capital allocation. Network uptime, validator performance, and operational transparency are evaluated before considering market momentum. Because in digital markets, capital flows where systems are stable. If you want to understand how infrastructure-driven insights can strengthen your digital asset strategy, visit and connect with Kenson Investments today at kensoninvestments.com.